Good afternoon and welcome to this ACT webinar on developments in the international tax and regulatory landscape. I'm James Lockyer, Development Director here at the ACT, and just before we start I'll explain some technical points about our webinar setup. There's a menu bar across the bottom that allows you to open various windows. You can move these around your screen, resize them or minimize them. The green button with the question mark on it down there is for help if you have any technical difficulties, and another button there opens the Q&A window. You can send in questions by typing in that Q&A window, and please don't wait until the end to send in your questions. Just send them in as they occur to you, and we'll deal with them at the end of the presentations. And our practice is that we don't disclose any names. I should add that a recording of this webinar will be available on the ACT website in 2 days' time, along with a separate copy of all the slides. Well, we're delighted to have speakers from Thomson Reuters and IMI plc here today, who have substantial experience in the practicalities of developing and delivering tax solutions for corporates. Thomson Reuters has sponsored today's webinar, so on behalf of us all, can I thank them for that support. Since the GFC, many governments, particularly the G20, have been battling to match overall revenue with overall cost. As the economic slowdown has reduced taxable earnings, governments have taken a variety of actions to increase the scope of the tax take, and more importantly, to extend the scope of what should be taxable. We're familiar with extraterritorial issues such as FATCA and the financial transaction tax, and we have seen local initiatives such as the UK's Google tax. However, there's also a potentially much bigger and better coordinated extension of the global tax take coming up fast, G20's Base Erosion and Profit Shifting Action Plan, or BEPS. And that's what we'll be hearing about today from Peter Mason, who's Group Tax Director at IMI, and Divya Ramaswamy, Senior Solutions Consultant at Thomson Reuters. Just by way of introduction, Peter graduated from Bristol University in engineering before qualifying as a chartered accountant and chartered tax advisor with Arthur Andersen back in the day. He later also managed treasury, assurance and risk activities in multinational groups, and he is also a prize winner with the ACT's very demanding MCT qualification. He's tended to specialise in tax management with global engineering groups such as Doughty, Smith Industries, Smiths Groups, Alstom, and is currently working for IMI. Meanwhile, Divya is a Senior Solutions Consultant for Thomson Reuters and focuses on the one-source transfer pricing technology. She has over 10 years of transfer pricing, tax and accounting experience, and prior to joining Thomson Reuters, she was working with tax consulting firms. And in her current role, she uses her subject matter expertise to help match technology to client needs. At the end of the presentation, we'll finish with discussion and as many of your questions as we can get through. So at this point, I'll hand over to Peter to start the presentation.
Thank you, James, and good afternoon, everyone. Let me start by just looking at the program overview. I'm going to walk through some of the changing tax landscape before we move into a detailed focus on BEPS with Divya, an overview of the sort of practical framework and what this means for corporate treasurers. We'll end with a case study to sort of try and bring this all together before opening up for Q&A. Seldom does a day pass when a tax story is not in the press. It's the newspapers now that are starting to be a major force in changing the tax landscape. And that's because in times of austerity, the public, that's all of us, needs to know whether big business is paying its fair share. Here are some recent high-profile stories. So which is the one out? Well, each of these four has a story that changes the treasurer's perspective. In 2011, Google paid only £6 million in UK taxes on sales of nearly £400 million. The UK tax authorities used multimedia sites like LinkedIn to investigate, and that gave rise to the so-called Google tax in the UK. It shows the power of the internet as a source of information for all on your companies. Starbucks had not paid taxes in the UK for years due to paying substantial overseas royalties, but following the ensuing media storm, it made an unprecedented voluntary payment of £20 million to the UK tax authorities. Perhaps donations now need to be factored into a Treasurer's cash flow forecast. Apple holds over $100 billion in cash outside the US, despite asking its treasurer to raise debt in the US. This is because of the substantial cost of bringing that cash back onshore USA in taxes. Apple's CEO has stated on record that Apple could be sued by their shareholders for financial incompetence if they voluntarily brought back the cash and incurred the taxes, so it remains in limbo for the Treasury. Now lastly, the bottom right, LuxLeaks is the odd one out, as not one company, but hundreds who had legitimately secured agreements in Luxembourg and elsewhere, yet those details were exposed by over 80 journalists around the world to be unfair in the public's eye, unwinding government-backed assurances with potentially massive costs for country and company. So what has this produced in new legislation? There could be many circles and acronyms on this slide, with the pace of change racing ever faster. I'm therefore trying to give some themes and trends, and starting at the top left. On Treasury matters, tax tends around the world to follow generally accepted accounting practices for the local accounts, with very specific legislated elections or exceptions. It does mean that the Treasurer needs to understand the local GAAP implications as well as the consolidated picture. However, if there is a perceived mischief in such a simple rule, many companies are starting to introduce a general anti-abuse rule, GAR, which is more a catch-all against tax planning. However, GAR reduces the certainty and increases the risk in a company's tax affairs, as they might be innocently caught. And then there are very specific rules, like the diverted profits tax, DPT, also known as the Google tax. DPT creates an entirely different construct for a transaction to result in a UK taxable presence that companies might otherwise have avoided under international permanent establishment rules. Now, as IMI is a global specialist engineering group, I won't profess a lot of knowledge on the Foreign Account Tax Compliance Act and financial transaction taxes, which are mainly aimed at financial institutions. FATCA targets US citizens with offshore assets, and FTT is aimed at specific financial transactions. However, it is likely that all companies and individuals will inevitably bear some of the costs of these measures. Lastly, we have base erosion and profit shifting actions from the OECD. Divya will cover BEPS in more detail in a moment. However, it is clear that BEPS sees interest on corporate debt as base erosion and on intercompany loans as profit shifting. I would like to look now at how that came about. There has been a long and sustained attack on the tax shield for corporate debt. Tax relief for interest has progressively been restricted, and this slide focuses on how this has been legislated over many years. There are too many ways to mention, and this list here is just the main ones, of which I'll highlight a few. Firstly, whether funding is debt or equity is getting quite complicated to determine nowadays, but fundamental for tax purposes. Documentation must be perfect, and often larger debt bundles are tranched to not risk all on one interpretation. Purpose of the transaction is paramount, and if done for tax purposes, it doesn't work, and so watch carefully what is said. Thin cap is a difficult concept and lives in the fairy world of trying to assess a subsidiary's credit score if it weren't a subsidiary. Earnings stripping is becoming quite common now, and that is a fairly simple rule using a fixed ratio to limit the amount of tax relief on interest. But what level is starting to occur in all countries? Withholding tax are also common ways to recoup taxes early and an instant way to impact tax cash flows. Intercompany lending is an essential tool for all treasurers to cash pool and move money quickly between countries and companies, but comes with a host of arm's length baggage. On the positive, equity is sometimes permitted to be debt with a notional interest deduction for tax purposes, to confuse it the other way. And what about FX? A whole complex set of rules pertains around that. Now comes BEPS, which is the final straw in this attack on the tax shield. And I'm delighted to pass over to Divya to talk us through some of these measures.
Thanks, Peter. I'll start this section by providing a bit of an overview around BEPS. Now, the table that you see on your screen will give you the timelines of all the 15 action plans that are part of this BEPS initiative. So stepping back a bit, the OECD, which is considered the most important body in the area of international tax law globally, was given the BEPS initiative a few years ago. The OECD then came up with 15 areas that they considered needed to be focused on to avoid issues of base erosion and profit shifting. The OECD has moved at a fast pace since then, and in its update webcast a couple of weeks ago, it mentioned that it is on target to deliver on all the remaining deliverables, as you can see, by September, October this year. And this is new for the OECD, wherein initiatives in the past have not really moved at this pace. And we should think about the reason for that. The G20 is behind BEPS. There's a lot of political will, and therefore BEPS is going to happen and things will move at this pace. And if you notice, I've highlighted a few actions on the screen. For Treasury, the most relevant actions are Action 2 on hybrid mismatch, Action 4 on interest deduction, and actions on transfer pricing. I've highlighted Action 13, but there are a few others on transfer pricing which are relevant to Treasury. Others on the list, for example, CFC rules, will also be important, but I think from the perspective of the webinar today, I'm just going to focus on some of the key actions and provide you a bit more of detail into that. So next, I am going to start talking about each of these action plans. As you can see here, Action 2 is on hybrid mismatch arrangements. Hybrid mismatch refers to a situation where a particular transaction or entity is viewed differently by the two countries for tax purposes. For example, if an entity in country A lends to an entity in country B, it is possible that this transaction is in substance considered as equity in country A but as a loan in country B. Now, this has a tax impact as interest in the loan paid by country B would be tax deductible, but the income of country A will not be taxed, say if it's considered as dividend and it's not taxed in country A. Now, this results in a consequence of the group getting a deduction for which no equivalent revenue or income is taxed elsewhere. This is but one example of a hybrid transaction and leading to hybrid mismatch. So the OECD is really thinking of ensuring some sort of a linking rule to match the tax treatment in these two countries. This could be, say, via denying a deduction for a payment that is also deductible in another jurisdiction. Now, just thinking from a practical perspective, what would be the challenge around that? It is definitely around that some form of information reporting will be required to really implement such sort of a linking or a matching rule. And that would mean more work for corporates. We are yet to see guidance around it, but we expect to see more guidance in the short term. Action 4 will be even more relevant for the audience today. Peter mentioned in his section that interest has been a focus area for the taxman for a while now. And yet, related party interest is one of the most simple and widely used profit-shifting techniques in international tax planning. Now, the BEPS draft on this action considers a lot more calculations-based options. For example, a group-wide interest allocation rule or a fixed ratio rule. For example, a fixed ratio would apply in relation to a benchmark ratio of an entity's earnings, assets, or equity. And this ratio will be determined by the country's government and will apply irrespective of the actual leverage of the entity or the group. So there are quite a few challenges around this action and the recommendation. What the OECD has given are a series of best practices, and this consensus is that, well, there'll be no consensus, and that each country would go ahead and set its own rule in terms of whether it's a fixed ratio or a group-wide ratio. So we expect to see really a disparate worldwide data collection system and a possibility that you will need to set internal financing structures to comply with various rules, which will just be incrementally more difficult. On the good news side, there is a view that from the public consultation that a de minimis rule may be provided so as to take out low-risk entities and reduce the compliance on them. So there are challenges, and we're going to await a lot more analysis in due course. And the last action I mentioned here is on Action 13 on transfer pricing. Now, Action 13 deals with transfer pricing documentation. OECD has historically not been prescriptive on what constitutes transfer pricing documentation. However, now specific detailed guidance on content has been provided. Documentation will form three parts: the master file, the local file, and a potential country-by-country reporting for certain entities. And very important to note here, that in the master file, one of the focus areas is intercompany financial activities. The master file mentions 5 categories of information, and financial activities is one of them. And this master file will be shared globally with other tax authorities. So it's not just something that you keep and file with you, you will share this information. And the country report will be specific to the entity, and country-by-country report would result in a lot more of information sharing and transparency. So definitely from all the action points, you can expect a lot more of scrutiny, information sharing, and transparency.
Yes, Divna, this is an incredibly important area, but it's probably worth emphasizing that the OECD, as commissioned by the G20, has made these recommendations, but they're out there and they have to be brought into national laws and enacted by countries around the world. And the key question is, when are they going to do this? Are they going to be doing it consistently? And what does it have as an impact on their competitive position in global trading? And so the jury is out at the moment as to when all these rules will be implemented. I think it's a high certainty that they're going to be coming in some form, but exactly when and how is a big question.
Very true, Peter. Thanks for pointing that out. Before I go in the next section, just highlighting the point around additional reporting and additional analysis that we will expect out of BEPS. So what is the impact of all this? What does this mean for corporate treasurers? BEPS will restrict the group's ability to deduct interest expenses. We expect this to potentially increase the group's effective tax rate, greater scrutiny. This will impact funding arrangements that have been currently put in place and your short-term funding plans. So you will need to revisit those. But for us, the challenge around BEPS is more about the pressure on the balance between tax efficiency and risk management. And I understand that treasurers generally play an important role in the group-wide risk management function. As today we have representatives from both sides, I'm going to ask James and Peter to just briefly comment on what their views are on this balance between tax efficiency and risk management in this changing tax landscape?
Well, from my point of view, I think the thing that really stands out that, I mean, for those who, I suppose, who thought that a tax or anything in tax was fixed, I think, you're in for a rude awakening. And, even for those of us who simply put in place something that's reasonably efficient without being too aggressive or whatever, there are now risks attached to that. And so I'm afraid, even though you're currently complying, that environment is likely to change substantially over the next year or so, and hence there's a lot more risk coming in.
Yeah, no, I totally agree. I think, it is very uncertain in the tax world these days. Tax laws are typically and often quite ambiguous, and selecting the particular tax result has an element of risk attached. And one might say that one goes to the more likely position as being the most appropriate for shareholders and the most consistent with the tax legislation. But when directors of companies have fiduciary responsibilities, potentially criminal sanctions against them acting on the company, one has got to be extremely careful how these issues are managed.
Thanks, James. Thanks, Peter. So what is the impact of all this in terms of, and we discussed some of the key points, and now we need to just think about how do you deal with them. So tax law, as you saw, is becoming more complex and is changing at a fast pace. Tax teams will need time to understand and assimilate these developments and then plan for execution. So really in your interactions with tax, you can expect multiple iterations or loops of discussions and data gathering. At the same time, given the increase in compliance for tax teams, there would be time pressure for turning around the information they have requested. And also, that is going towards a lot of information gathering and a lot of granular details. So it's not just about volume, it's also about the level of detail within that information. And that's why I've summarized these key 4 points that, yes, it'll be complex, there'll be more iterations, expect short turnaround time, and a lot more granularity of detail. Now, when you see these challenges, let's think a bit about how you in Treasury can get prepared to make your life easier in these interactions with tax. And today's webinar, our focus is in that practical perspective. The framework we have provided here is fairly simple. Be in control of data. Take transfer pricing as an example. In my experience, I've seen most Treasury teams are not aware of the number of intercompany financing transactions, their current positions, their pricing terms, or have an auditable way of benchmarking these transactions. Be aware of tax changes. We have 150 plus people joining this webinar today, so clearly you're keeping track of tax changes, and the ACT is doing a wonderful job of really adding such areas into their agenda. Now, most people then stop with just understanding and talking about tax. But I have to reiterate the importance of setting in place efficient and, where possible, technology-enabled processes to manage this. For example, there are solutions in the market around FATCA, around transfer pricing benchmarking, around data consolidation aggregation. So for you and your tax teams, it will be useful to think about how to make your processes more efficient so that you're geared up to dealing with BEPS and the other tax challenges that you are going to be facing. And so far, in terms of thinking about the framework, I have looked at it from a perspective of how Treasury interacts with tax. I think having Peter here, I just want to get his practical views on how, with his tax hat on, how he deals with Treasury.
Thank you, Divina. Well, as a corporate treasurer as well, I know the value in the ACT training to think logically, be strategic, and understand the business case, while also bringing a financial acumen to bear on any project. And it is crucial that treasurer is working very closely with the tax function to understand the tax implications of all of those issues, because ultimately that comes down to the post-tax cash result, which is the true return on any business case. And in that way, I think the teaming well of tax and treasury together drives optimum value in supporting the business. Okay. I'm going to come on now to a case study. This tries to pull together some of the tax themes we've been talking about in a value-based way. There are huge simplifications and assumptions here, but I hope you'll see how there is significant volatility in the earnings results, requiring clear understanding and careful management of how corporate debt is managed within an organization. So let's start with, as I say, once upon a time, there was Company A in Country A and Company B in Country B, both earning 100. Yet Country A has a tax rate of 20% and Country B has a tax rate of 40%. Then A buys B. It does it through debt funding with an interest cost of 50. And you can see, because that 50 is relieved in the acquiring company, Company A in Country A has a 20% tax rate, the overall tax rate here has gone up. If I just flip back to the previous slide, you'll see the overall red rate in the bottom right was 30%. It is now gone up to 33% because of the relief on interest being at a lower 20% rate. Clearly, the shareholders of B have profited from the money that the company has acquired, and that's not being pulled into this example. So an organization may look to restructure to have actually a holding company in Country B perhaps acquire Company B, and that would allow the debt to be shifted or to be placed into Country B. In that circumstance, it's now being relieved at the higher tax rate in Country B, 40%, with the overall tax rate coming down now to 27%. And that shows the flexibility of where the debt is placed. Now, if actually the debt had to be held for treasury reasons at the parent company for maximizing on the credit rating, Company A could lend to a holding company in Country B and who would buy the Company B. And if it was lent from one to the other, Company A would need to make a margin. So the loan might be at 70 of interest rate or interest charge, so that Company A earns 70, pays away 50 to the external lenders, and so has a net 20 turn under an arm's length philosophy that it should make a return on its funding activities, and that Company B is probably a lower credit rating because of its debt and balance sheet. In that scenario, the tax rate reduces further because there is increased deductibility in Country B, and in fact a profit being earned on the interest in Country A at a lower rate. The skew gives a positive tax effect. This shows how interest can play advantages. Now, governments have tried to attack this, and we've talked about some of the metrics of perhaps an earnings stripping limitation in Country B, where the interest is limited to only 30% in Company B of its profits. Now, you'll see the interest column doesn't cross-add because not all the interest is receiving tax relief. The result is a massive hike in the overall tax rate to the group, and that is the consequence of some of the earnings stripping or Article 4 of the BEPS program type agenda items. Now, of course, companies have become clever over the years, and advisors have brought in things such as Divna was mentioning, hybrid type structures, where in this example, the interest is being fully relieved in country A, in company A, but none of the intercompany interest income is being picked up in company A. And therefore, there is effectively a double deduction of almost the same interest in company A and B, which is the focus of one of the current BEPS initiatives. But you can see, and a common technique applied by many FTSE 100 groups, that reduces the tax rate down further. Of course, BEPS is on the horizon, and the implications of BEPS is likely to be that no, that interest income will be taxed in country A, and we had last 70 of a charge between A and B, 70 being taxed in company A, less the 50 paying out externally, leaves it being taxed at 20. But BEPS under Article 4 is very likely to even further restrict the deductibility in country B, company B's interest cost, perhaps 10% of its profits, with a massive increase in the overall tax rate. Now, just putting that all together, you can see on this last slide the graph on the left goes through those 7 examples, and you can see the tax rate moving from 20 to 40% broadly over those examples, showing the huge volatility in this area. And that difference between the higher and lower tax rates can add nearly 30% to the cost of debt. So what is the impact on corporate treasurers? Well, they need to be able to justify the acceptability of interest deductibility with their tax function on many footings at the company level. These are times of change, and there is potential for significant unwinding of financial structures and acquisition structures over the next few years as BEPS starts to become legislated. But what does this mean for M&A going forward and project evaluation? And how would you go and calculate your WACC and the tax shield associated with the debt? All these uncertainties reduce willingness for intercompany debt, but that does remain a key tool in global cash pooling and moving cash efficiently around a group. FX and cash flow practicalities need to be considered, as well as the implications on distributable profits. But finally, the Treasury and tax documentation in all these areas are critical. We are certainly in rapidly changing times, and the corporate treasurer needs to be alert to all these developments and nuances. Thank you.
Peter and Divya, thanks very much indeed. Few questions, I think, that we've got stacked up. I think the first one, just looking at the overall rollout of BEPS through particularly the G20. Do you see it being as well coordinated as they'd like to? And also, do you see the approach being coordinated? How much cooperation is there between the G20 in particular, and how much are people actually starting to try and use BEPS to lever up their own individual positions?
Well, I think there's great cooperation amongst the G20, and particularly the tax authorities are regularly in communication. The problem is that each country does have a different agenda. And if you look at the likes of the USA, which I think has been a little slower to pick up on BEPS, to some of the European countries that are moving ahead much quicker, and then developing countries have potentially slightly different agendas. So the coordination of all of this together with all of those different interests is going to be extremely difficult, and that is the big question mark.
I agree, Peter. I think there is a lot of effort or initiative within the OECD to get more countries involved, and not just the G20, it is also the other developing countries. But then, because they want such a big consensus globally, the coordination is that much more difficult.
Just sticking with the G20 a moment, I think certainly one of the opportunities opportunities and challenges that I can see coming up is whether people sort of see BEPS coming through the G20 and say, you know what, I just want to minimise my exposure to BEPS. Should I be looking at a Treasury centre in somewhere a little bit more friendly but yet sophisticated and law-abiding that is outside the G20? For instance, Hong Kong or Dubai, both centres which are actively ramping up their capacity to support, in particular, corporate treasuries. To what extent should treasurers be actually genuinely looking around the globe, thinking of, where should Treasury be located?
Well, I think it always needs to be considered. However, there is a developing program by the more sophisticated, perhaps higher tax rate countries to start to discourage treasuries going to those other areas. And if the treasury activities are very isolated and don't need to interact with those other countries, then it might be acceptable. But if they're interacting with the US, Europe, those areas, the implications of things like withholding taxes and other tools that governments have available to them means that there is still significant tax issues that they will have to be dealing with.
Right, and of course we won't know about that until we see BEPS being rolled out jurisdiction by jurisdiction.
And there are other programs as well that are moving in a similar direction. So, the tax world is constantly changing at the moment. It's very difficult to plan forward with certainty, and making large decisions such as relocating treasury functions or even down to the areas of M&A is fraught with difficulty.
I think my view is that some of these areas which is now being mentioned in BEPS has always been best practices. For that example is a point on substance. So within transfer pricing, substance has always been key. But I think BEPS is now a tool by which tax authorities say, actually, you need to focus on it. So I think wherever you place yourself globally, your local, in this example, transfer pricing rules will continue to make you ensure you are tax efficient and you are thinking about having the substance and not just legal form.
Okay, thanks. We've got another question here. Sort of looking slightly beyond Treasury, BEPS clearly impacts the entire business, not simply Treasury and not simply financing. And there's a question here saying, will this encourage companies generally to actually really focus on where they do the things they do? And it goes on to a point I think, Peter, you and I were discussing earlier about, what does the supply chain look like and what impact might that have on the supply chain and the overall location of operations within the group?
Totally. I mean, it's BEPS has many features and facets to it, not just on corporate debt and interest. So the primary program of BEPS is enhanced transparency and disclosure by all corporates under really public demand to know exactly what companies are doing. But it was also focusing exactly on where profits are made and where are they taxed and how are the rules applied to determine those results. And in that perspective, BEPS is changing very fundamentally some of the potential supply chains that organizations like ours are using for trading and their normal export from one country to another. But it's almost certain now that in both countries there will be a tax implication.
Yeah.
And so everybody is refocusing and relooking about how to make sure that we comply fully with the laws and meet all of our obligations for tax in all of the countries.
Yeah.
It's a huge burden.
And then meanwhile, the classic the classic tax type problems are sort of being magnified. You know, you get taxed twice on the same income, you don't get the deduction, or even better, you you get taxed twice on the income and you don't get the deduction. So there's the risk that all of this compounds up.
And I think that's the reason why one of the action plans is on sort of shoring up that treaty, shoring up the mutual agreement procedures. So that's a few of the actions in BEPS are just, they understand how complex this is going to be, and therefore those kind of actions on better double tax treaties is also an action point under BEPS.
Yeah, and that the risk of double taxation is a significant concern for multinational companies these days. And I've heard my colleagues say, in some respect, one would prefer to say, this is our profits, you, the government, determine where it falls, because then we've got certainty. Because trying to work it out now,
Yeah. Okay, I think we're going to have to start closing down, unfortunately, just when we're getting into it, as always. I think from my point of view, just going through some sort of key points. I mean, first of all, BEPS is huge, and it's coming. Another sort of tax steamroller, if you like, facing corporates and, of course, banks. Businesses of all descriptions everywhere, particularly in the G20. I think the things that I've taken away is, although everything's very uncertain at the moment, there's a huge amount that can be done now in the way of information gathering. What do your supply chains look like? Who is selling to whom, particularly intercompany, and where? What is your corporate structure, and why is it built that way? And could you run it in another way? And where does profit arise in that corporate structure? Where are your remittances, your royalties, your dividends, and indeed, what's your cash management structure look like at the moment? We haven't even touched on cash management yet, but there are BEPS implications around that. I think the other thing in the information gathering is starting to properly map resources to taxable profit. And I suspect that when people try and start doing that, they'll find that there's a lot of information they simply don't have, because it's something you never actually sit down in the business and match your taxable profit to the resources. Taxable profit is something that almost comes out independently from the accounts and from the tax regime. Certainly on project evaluation, I think it's more important than ever to run sensitivities around what happens when the tax treatment of the cash flows that justify the project change, and also running the sensitivities on your weighted average cost of capital. How big is your safety margin before a project becomes, in present value terms, break even? And going on from that, I think any major acquisition or investment needs to be done with extreme care. And I think project evaluation is almost now starting to be a bit of a leap in the dark, because it's going to be, 18 months, 2 years, until BEPS comes through, and then on a piecemeal basis. So, on that happy note, that's pretty much it, I think. My thanks to our presenters and to Thomson Reuters for their sponsorship. Thank you too to everyone who joined today's session, and I'm sorry if we didn't reach your question within the time. As I mentioned at the start, we'll be putting up a recording of this webinar on the ACT website, along with the presentations, in a couple of days' time, and we'll be sending you all that link to that in due course. Just to cover off some upcoming events, our webinar series continue. The main conference season kicks off in September with the Asia Conference in Hong Kong, and also the conference in Dubai and the annual dinner, plus London conferences on working capital and funding. Thank you very much for listening, If you can spare a moment to provide some feedback on the webinar, we would be very grateful. Just select the feedback widget in red from the bottom bar, and the facility to do this will remain open for a short while after the webinar ends. From all of us here, thank you and goodbye.